Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating the session tonight with Rob Roy. As always, we need to go over some important housekeeping details about the session, and then I'll introduce Rob. So first and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website if you'd like to read it in full detail there, or certainly feel free to take a screenshot of it now if you like, but that's the main point to take away. So I'm pretty sure most of us out there are familiar with the Q&A process once we get to that last 15 minutes of the session. So I'll just leave that visual up there for you for review, or for anyone that might be joining us for the first time. If you are joining us for the first time, welcome. We're very excited to have you on board with us. And so with this session, we'll go ahead and get kicked off here. I personally am wondering what Rob is thinking with today, the news that came in. The market is waiting with cautious optimism. And you see what I did there? Rob's been talking about that for so long now. The cautious optimism specifically said we should proceed with cautious optimism. So just thought that was interesting with that exact phrasing that was used. And as we all wait the Fed announcement tomorrow, I think Powell's tone will likely dictate a lot of the market's next directional move. So very excited to hear Rob's thoughts on that, and of course excited to interact with you all. So at this moment in time, I'll introduce the man of the hour, Mr. Rob Roy. How we doing tonight, Mr. Rob?
Doing great, Zach. How you doing?
Oh, fantastic. It's the best hour of my Tuesday evening every week, so happy to be here.
Well, happy to have you along. And there's a video. Hopefully everybody is seeing the screen now. And as you mentioned, the market is awaiting the Fed meeting tomorrow. And the thing that's been a little bit confusing to me is Powell has said there's going to be 2 more rate hikes, but the market seems to be thinking that there's going to be 1 more and then that's it. So where they're coming up with that, I don't know, but it's definitely not what Powell and the Fed have said. So we'll see how hawkish Chairman Powell sounds tomorrow. But the market has been kind of just waiting on this. We had a big move up here on the 19th, a little bit of a drawback, and then kind of right back to that level. So we're just sitting here waiting to see how that's all going to play out. If we remind everybody of the zigzag pattern that we talked about for a while, we hit the first fib level, and that was at the 61.8% level. And now we wait to see, are we going to move up to 465? I guess we'll find out together tomorrow based on how the market reacts. Remember that oftentimes what happens initially after the Fed announcement gets retraced, and then a day or two later, we figure out what the direction of the market actually is. So we've hit the 61.8% level with the B wave correction. That's the target that was expected. So I just want to be clear that the zigzag has done what it's supposed to do. Now we look to see if we can expect an extended C wave up to that 100% level. We like to look at the DMI for that. And that ADX is pretty high. It's above 40. We did get a tick up in the positive directional indicator and a tick down in the negative, which means the buyers are still in control. So as long as that ADX is going up, we can stay with that cautious optimism, trade what the market gives you, not what you think is going to happen. I know that what's going on is confounding to a lot of people, as your comments tell us on our YouTube videos. But if that ADX were to break back down below 40, that tells us that this wave 3 move is over. For now, we just continue with this upward move. I'm going to show you an example here in a minute, but we've had some bullish alerts go out to our subscribers at EWOtrader.com, and they've been detailing that cautious optimism. So I'll tell you about that more in a few minutes. Not much else to say about the SPY. I do want to look at interest rates, though. We got to move back to the upside here. And if you've been watching us here at TradeFinder for quite some time, you know this is nothing new to you. Been talking about this range between 34 and 40 on the 10-year, the TNX. We tried to break above it, no follow through, came back down, got within this trading range, which is what I consider the sweet spot for even the high tech stocks, the Qs, etc. This move back to the upside just maybe a little bit of protection going into the Fed meeting tomorrow. but it's really kind of no harm, no foul because it's not back above 40 yet. So it's nothing to be concerned of. We closed above the 10-day moving average yesterday, gapped up today, but nothing really matters unless we break back above that 4% level on the 10-year. So I think just this move up today is in case Powell maintains his hawkish stance, which he has been for quite some time. Perhaps the optimism is coming from the fact that we got a little bit weaker inflationary data, and maybe the Fed will say, hey, we're just going to do one and then we'll wait. But that's going against what they said in their last meeting. So again, we'll see how all that plays out. Looking at the dollar, man, the dollar is just teasing us with an entry into the metals. As you know, again, if you've been watching this, we're anxious to get into the metals, the SLV, GLD, whatever your favorite symbol is there, ETF, gold or silver. And we talked about breaking below this support level at 101. And last week did not expect it to be so vertical to the downside, and that we would at least come back up and test this 101 level. We did test it. We are testing it right now. We're slightly above it on the close today. Well, I know it continues to trade just like Bitcoin does, et cetera, but we do get end of day prints for end of day programs such as this. But we're right there at the 101 level. If we continue to the upside, that'll be negative for the tech stocks and metals. But if we break to the downside here, which we could because we're still in a qualified 5-wave to the downside pattern, if we do break back below 101, I think that's the entry for the metals. We held off the temptation to jump into the metals with this break below because it was so vertical. It was too vertical. And again, if you've been here, you know I don't like vertical moves, and it's because vertical moves normally get retraced, and that's exactly what the dollar did. It retraced back up. So we're testing 101 right now. It's such a key level in the dollar. So we'll let that play out over the next couple of days and see how that works out as far as the metals. I thought I'd go ahead and show you the SLV right now. Remember that this 5-wave pattern has been disqualified because the wave 4 here was below 78.6% level. So we take the Elliott Wave pattern off, and basically we're just looking for a new impulse pattern. We could look at this and say, are we in the midst of a new zigzag pattern to the upside? If we are, then the retracement pretty close to 50%, and a 100% extension would break us above that 24 level. And I don't think 100% would be the end of it. I think we would likely have an extended C wave at that point, but this is all conjecture. It all matters what happens with the dollar over the next day or two. So getting back above 23 as an area of resistance is what I've been looking for. We hit it, we backed off. Maybe we get back above there, depending on what the dollar does over the next couple of days, but that's going to be the key. And so again, as I said, we held off. We didn't get suckered in on this vertical break below it just because it was just too vertical. Looking at the VIX, just hanging around this 5-wave low level. And I mentioned that 61.8 is the strongest of all, in my opinion, fib levels, and it's held so far. So the VIX is just kind of trading around here. We had talked about the likelihood of coming up and testing this 17 level because that was support for so long, and we broke it, and we did test it, and we've stayed below it. So something's got to give here. Are we going to break below 13 and head lower to the 100% extension maybe in the wave 5, or are we going to hold here with 13 being the low and we turn and move back to the upside? I think we'll have some answers by the time we meet again here next week. I think that's going to be the key. That'll tell us where things are going to go. So let's look at some of our other markets here. The DIA, the Dow is on one heck of a winning streak. And that makes you wonder too, is that money that's moving out of the S&P, out of the NASDAQ into safer equities, if you will, because the Dow is the 30 largest stocks. makes sense that that's a place to hide. If you're a little concerned about where things are going to go from here, one thing we do know for sure is there has been some rotation from the S&P and the Qs into the Dow, specifically the DIA that we're looking for. And look how we are right smack in the middle of that tap box. Time and price projection, the wave 5 is where the algo thought we would go. That's the Elliott Wave algorithm I'm talking about, and it's exactly where we've gone. The lower and the upper end of this tap box time and price projection is basically your margin of error. So we're there. If we look at the 10-day moving average, it's catching up, but we're still a little bit overbought on the Dow, which I think makes a lot of common sense with the number of up days in a row. If we do lose some more momentum out of the SPY and the Qs, does that give us further move to the upside here on the diamonds, or is the money that wanted to go there parked and it's going to just kind of hang out there as we see what happens as far as any sort of recession data by the end of the year? I don't like the fact that the 210 yield curve has been inverted for so long. So many people are now just discarding that as it's different this time. My experience over 27 years is it's never different this time, and you always need to pay attention to the bond market. But we seem to be moving away from that, and I just think that's dangerous. That leads to the cautious optimism. You have to trade what the market's telling you, even when it goes against what you think should be happening. But it doesn't mean you have to go in willy-nilly and just, balls to the wall on the upside. Find your spots. Stock pickers market, find your opportunities, but be cautious while doing it. So take what the market is giving you, but not with reckless abandon at this point in time. And note that we have had a bit of a drop off on the volume, even as we've gone up and consolidated these highs. So that's not a positive thing. But the fact that we're a little bit overbought, a move back down towards the 10-day moving average, even if we came back to test the wave 3 high, would not be bearish in any way, shape, or form on the DIA. That would still be, in a bullish scenario. We're just a little bit overbought right now. So it doesn't mean the end of the world if we were to pull back and come down even to that 345 level, on the DIA. So looking at the Qs, and they have recaught a bid. So there is some money moving in there with the expectation, I think, that maybe, just maybe, Powell backs off a little bit. But once again, when we look at the volume, there's not a lot of conviction behind it. So we had this move to the upside. We've backed off. So a little bit of a bid today. Maybe some people trying to get in front of Powell saying, hey, we're one and done. And then that would let things take off again to the upside. We would continue higher on the Qs, but that would be the Fed changing course. And I just don't see it. Now, I could be wrong. I hope I'm wrong, but I don't see that yet. They've stayed pretty staunch on their hawkish stance. I think if I were to guess, and that's all it is a guess, so my guess means literally nothing, is that Powell will come in and say the inflationary data looks better, but it's still too high. That's what I feel like they're going to say. Now the key will be, are they going to stay with 2 more rate hikes by the end of the year, or will they back off of that? And that's going to determine what happens from here. I think that's going to be the key. Now the IWM did have a nice move to the upside, broadening of the rally, if you will, but it's kind of stalled here around 195. Also, just right. I mean, if you're not a believer in Elliott Wave after you've been watching this, I don't know what it takes. You can see that we had the tap box here with the wave 5 forecast from the algorithm in the middle. This is all the Elliott Wave algorithm that Ralph Nelson Elliott wrote over 100 years ago, and it's just absolutely nailing what's going on with the market. How can you discount this? I just don't think you can. Haters will always exist out there, but when you're right, that's when the haters come out. So we're right here at 195. The key is not 195 on the IWM, it's 190. The trading range between 170 and 190 has been in place for, as you know, quite some time. We did refined the range down for a few months there between 170 and 180. We broke back above it, tested 190, came back, tested 180, and broke above 190. And then we went up and tested those highs back here just underneath 200. And that's where we are. So we'll see what happens with the IWM. The 10-day moving average has caught up. Doesn't mean that we can't test 190 one more time, but we don't have to. We've tested it. We're at the 10-day moving average. We're not overbought on the IWM. If, and that's a big if, the Fed sounds the least bit dovish, then perhaps that's the key for one more big run in the market, and we break above that tap box high there, the highs from early February on the IWM, and perhaps we run up towards 210. If you remember way back, the trading range was between 190 and 210 on the IWM, but that's been quite some time ago that's the trading range that we've been in. We broke back down and been in this 170 to 190 area for the past year or so. But that's what can happen. Break that back down below 190 would occur, I think, if the Fed sounds maybe even slightly unusually hawkish, but you know, if they just come out with their normal hawkish tone, that could even bring us back below 190. But if you're a fan of the small caps, if you're a believer that the small caps are the risk on, risk off type of analogy, then keep an eye on that 190 level. As I mentioned, Bitcoin, it looked like we were off to the races. We were going to break above that 31,000, not so fast, no follow through. Just one day above it and then right back down we came, and we've been holding in this 29,000 range. It's a bit of support going all the way back to March. Also exactly where the 50-day moving average is. So you can see we've come down, we've tested the 50-day moving average. That, you know, it may feel a little bit bearish to you, especially if you thought we were off to the races at 31,000, but coming back down one more time to test the 50-day moving average. I actually think this is really bullish, again, because we hadn't retraced this vertical move at all. And so now we've retraced a little bit of it, just exactly like we did back here when we had this vertical move up from the March lows, came back down and tested that previous wave 3, which gave some give back from this vertical move. Perhaps that's all we're doing right now, and the 50-day moving average holds and we turn and move back up. I just think at this point in time, if you're long Bitcoin, obviously there's no reason to get out when you're above the 50-day moving average. If you're looking to enter more positions in Bitcoin, I just don't think you do that until we break above 31,000 with follow through. Then we could be off to the races. You all know we've been talking about the halving that occurs in the first quarter of next year, and the fact that historically about 9 months before that, Bitcoin tends to make a rally, and that's exactly the time frame that we're in now. So perhaps we test this 50-day moving average, break back above 31,000, and off to the races we go with Bitcoin and the whole crypto world, coin, etc. Maybe that'll come up in the Q&A. It has an awfully lot lately, but for now, hanging in here around 29,000 is not bearish at all. Just holding that 50-day moving average, tiny bar here, so not a lot of volatility in today's trade. A bit unusual for what's been occurring in Bitcoin, but that's going to be the key there to see what happens moving from here. So taking a look at a few of our international markets that we like to look at, the EWA for the Aussie market has been in a bit of nail-biting type of area. They're around that 22 level, and it held. We got back above 23, and we're trying to make another run to get above this resistance area. It's not quite at 24, but that previous wave 3 high back in November is right here just under 24. We tested it there in April. We kind of made a run in May. We made another run now in July. We backed off a little bit, but just to the 10-day moving average. We were overbought on this vertical move here in early July, and we just came down. Look at that, tested the 10-day moving average on the low, and then heading back up. I still think this is just a wait and see mode there if you're long the Aussie or interested in the Aussie market. let's let it break above 24 with follow through. Then I think we may be off to the races, at least to get up to test those previous wave 5 highs from January. But there's no need to guess. There's plenty of room to trade when the market tells you which way it's going to go. So far, it's just been a trading range between 22 and 23.5. So let's let it tell us what it's going to do from there. So looking at the Canadian market, the EWC back up towards resistance here at 36. It looks like it is chomping at the bit to break above this 36 level in a wave 3. Big, huge zigzag pattern here. So if we can break above that level on the EWC, then we could at least go up there. Looks like 37 is 100% extension. Seems like if we break above these highs that went back to December, January, February, May, and now again in July, that if we break above these levels, 100% extension is probably not the end of the move. We might be looking at the 161.8% extension, but it's got to get there first. So we're just hanging around right at this 36 level. We got slightly overbought. A rest day today was just perfect if you're long or interested in being long the Canadian market. So 36 is the key there. If we can break above it again with follow through, a little bit of a move to the upside at 37 and see if we move higher. I would say that we probably do, but note that that wave 5 target there in the tap box is right just above that 100% extension. So maybe we get a little bit of resistance here at the 37 range. But I think the EWC will react as our market will tomorrow based on Chairman Powell's comments and what comes from that. The INDA, which, as you know, if you've been watching, has been on one heck of a tear, coming off those March lows, just as ideal as you would want an uptrend to be, right on that 45-degree angle plane. And the reason I like that, if you're newer, if you're just watching and haven't heard this 9,000 times like people that watch every week have, the 45-degree angle moves I like, because when you have a trending move, the market moves in impulses and corrections. It always does. That's the basis of Elliott Wave. That's what Elliott Wave does, is it measures those impulses and corrections and tries to give you the next likely move. But when you have a 45-degree angle move in the trend, the corrections tend to be less severe. They don't get corrected as hard. And that's what's happened through this whole time. We have had corrective moves, but very slight. And the trend has continued. We're still above the 10-day moving average. So you have to say that barring something really significant occurring in the market, we could be looking at a target price of 46.5 on this move on the INDA. When you've had a move that's that mature, you do want to look at the DMI, and you can see that the ADX is kind of leveled off here above 40. That's okay. Sometimes the ADX will go sideways in a strong move. It's telling you that this part of the move was stronger, and whatever happens from here will not be as strong as the move that occurred basically back from end of May up till now. That's the stronger part of the move. But it doesn't mean the move is over. We can still go higher, but when you go higher and it's not as strong, you just are a little more cautious and again, trading what the market's giving you, but a little more caution and perhaps tightening the stops just a bit, but still looking really, really strong on the INDA. So looking at the EWG, 28.29, as you know, has been, that's all we've talked about for a while, and we're still there. We went up and tried that 29 level right at those wave 5 highs back from April and May, and we hit it, and you can see it was just like bam, smacking our head against the ceiling, and we couldn't get through it, and we're just trading water through here. If we can break above 29, I think it go long the EWG. But if we break back below 28 with follow through, then I think you can look at a short on the EWG. Staying between 28 and 29 is just a wait and see type of move. Going back, if we would have known that back in April or May, you probably could have done pretty well and maybe a little bit of a butterfly here, but it's been going sideways for so long now. I don't think you'd want to do that now. The fact that we've been in this range for so long, the likelihood is we are going to break one of those two levels, either break above 29 or below 28. So I don't think at this point in time it makes sense to put any sort of a sideways trade on. Let's just wait and let the market tell us, EWG tell us, are we going to break higher? We're going to break above that 29 level or break lower, and we go from there. And that'll be the key to decide what we do with the EWG. So, you know, we're all in wait and see mode for Chairman Powell tomorrow. And the optimism that I think is probably a little too optimistic, in my opinion, again, just my opinion, that the Fed may back off at 2 rate hike. I just don't think they're going to do that. I think they're going to go ahead and continue with the idea of 2 rate hikes, and then we'll see what occurs from there. Some earnings after hours, as you know, so I imagine those will come up in the Q&A. So I'll let that go for now, and then we'll see what y'all are interested in when we get to the Q&A. I did want to show you we have been just doing exactly what I said. Put our money where our mouth is. We've been picking and choosing. We had 3 bullish alerts that went out to our alert subscribers at EWOTrader.com, and we were quick to take them off. So we had 3 winners to the upside, 3 bullish trades to the upside, all 10 days or less. This one that I'm showing you is on PAYX. Here, this one was less than 1 day. So the entry alert went out on July 10th, and we take a look at the chart, and you can see that, again, the zigzag, which I love, giving us a 100% extension at 118.60. If we go to an extended level, that's up at 125, and literally less than 24 hours later. That's why this says 0 days, because it was less than 24 hours. So after the alert went out, PAYX went higher, and then the next day it went higher. And look where the high was. The high of the day, 118.63. So it hit that 100% extension spot on. We're nearing an area of resistance. One of our general rules here at Elliott Wave Options is if you can get 30% in 3 days or less, we're going to take that. Well, in this case, we got 34% in less than 24 hours. We're going to take that. You can go back and look at the chart of PAYX and see that it did continue higher, and you can say, hey, you got out too soon, but you know, you can get 34% less than 24 hours. Just not going to turn that away. We're going to take that. You can't go back and second guess yourself and say, oh, you could have made more if you'd have stayed longer. You'll drive yourself insane if you do that. If you're happy with the gain when you got out, be happy with the gain no matter what happens from there. And that's how we look at things. So in fact, all 3, if you go back and look at all 3 of the bullish alerts that we've had in July, 10 days or less, all of them went higher after we took them off. We could have made more on each and every one, but we had 3 great winners. And as I said, we are not going to come back and second guess ourselves, and we're not going to feel bad about the fact that we had 3 quick bullish winners all in less than 10 days. So we're just, you know, we're not going to second guess ourselves. That's how things go. Taking a look at the case study considerations that we've had over previous TradeFinders. And boy, I hope you've been following these, because what a run we've been on our TradeFinder alerts. And then we had PRIM, which we entered back on June. Well, we identified, I shouldn't say we entered them. And that's actually the difference between what we do here at TradeFinder, where we find case study considerations, and then you're kind of on your own. Find a trade, when do you get out, do you adjust it, etc. The difference between that and the alert service that we have at EWOTrader.com is that at EWOTrader.com, the alert service, we send you out alerts for entries, any adjustments, and exits. So we kind of guide you through the position, hold your hand, if you will, rather than just leaving it up to you. That's the difference. So we looked at this, and normally we look for about a 10% move out of these directional trades. So that would have gotten us up to about 32. So we had a nice move. And then here we go on the 21st of July, we did get up to the 32 level. So if you've been following along and watching, you should have gotten out. And it's almost like PRIM knew where our exit was, because look, as soon as it got up there, it reversed. Now we're back up today. So we closed at 31.12. We hit 31.33, but we did hit that 32 level. So I'm going to cross that one off because it did hit our target. That's another winner at TradeFinder. So that one's done. And then AFLAC that we looked at on 7.4, our target price was 73. And the target price came from resistance. There's resistance right there at 73. So this was our July 4th edition of TradeFinder. Obviously, the market was closed on July 4th, so this was as of July 3rd. But we don't take holidays off here at Elliott Wave Options, so we were here with y'all celebrating the Independence Day. We had fireworks in the background, etc. Decorated the background here with July 4th stuff, and bam! How about that? Yesterday hit that 73 level on the high, backed off a tiny bit today. But there's another one we had written down. I have it written down right here. And yeah, I'm old school. I write stuff down. I don't have all the fancy spreadsheets, etc. I still write things down the old-fashioned way. And 73 was our target. We hit it. If you didn't exit, you're getting greedy. When you have a trading plan, follow your plan. It's easy to go back and Monday morning quarterback, second guess yourself, whatever. That was our target price. We hit it. That's yet another winner that we've had here. And that's another one that's off the page here. So we're running out of past identifications to look at. And then we had VEEV. Now, if you remember, we gave you two of them back on the 11th, and we'd already gotten out of the first one, FFIV. And so we had VEEV, you tried to say, and there's our target at 212 there. The 100% extension on the zigzag, and bam! So you don't think this Elliott Wave stuff works? Look what's happening on these target prices that we're giving you. As soon as we hit it, and we hit it dead on, 211.95. Okay, so we got within 5 cents of the 212 level, and as soon as we hit that 100% extension, it reversed. But that doesn't matter. We hit our target price. Again, if you were following this and listening to what we had said, you should have gotten out. And that's another winner. So we're taking that off as yet another winner here. And that leaves us with just one left. And that was last week's case study identification on MTB. We actually have an alert for our alert subscribers at EWO Trader on this as well. And the first target price there is 140. And then we have to see what happens from there. Well, guess what? Boom, that's where we are. So we're profitable in this position. We're at our 140 level. And you look at the DMI, it's still supportive. We've gone sideways since we hit the 140 level. So the positive directional indicator has come down a little bit. That's not ideal, but the negative directional indicator has still continued to go lower. So it's not like the sellers have reared up. It's just maybe a little less buying interest here as we hit this resistance area. We knew 140 was going to be resistance. So as long as the DMI is still constructive, I think we should hold this one, see if we can break above 140, because if we do, looking at how vertical this move was down here, we've got the chance of going much higher, even possibly all the way up to 160. So let's at least give it a chance and see if it can do that. We're a little bit above the 10-day moving average, so we were a little bit overbought. We hit 140, and another one of our rules, if you hit a resistance area and you're already overbought, you don't want it to break that resistance level when you're already overbought, because those breakouts tend not to hold. So the ideal scenario, go sideways, consolidate underneath resistance, let the 10-day moving average catch up, gain some momentum and energy, and then see if we can break above 140 there. So we've got a gain. Let's see if we can break above 140 and continue with this move higher. We'll let the market tell us what it's going to do. Maybe, this is a banking stock, so maybe it's going to wait and see, how things shake out with the Fed tomorrow as well. Or maybe it's just consolidating the overbought scenario, which is perfectly fine as well. So we'll leave that one for now, but that's the only one we have left. So if you've been watching TradeFinder for years now, and you've watched all these case study considerations. You've seen the examples that I've been giving you on the alerts that we send out to our subscribers at ewotrader.com. So if you're here and you're not a subscriber at ewotrader.com, the hell are you waiting on? I mean, what do we need to show you? The results speak for themselves, basically. So if you've been considering it, no better time than now. What if the market does correct? Are you going to know what to do then? It's easy when the market's going up. Everybody makes money when the market's going up. But what happens if the market corrects? Well, zigzags work to the downside just like they do to the upside. So we don't care whether the market's going up or down from a directional standpoint. So if you've been waiting, you've been thinking about it, there's no better time than right now. Go to ewotrader.com and become a subscriber. We'd love to have you. Every Thursday night, we do a 45-minute Q&A at the end. So that just kind of keeps us up to date on where we are with the markets, our case study considerations. Let's take a look now and see if we can find one. This one's kind of tricky tonight with the big Fed meeting tomorrow. So if we take a look, we can say, holy cow, there are 9 results. That's in the upper end of things on the impulse search. And so let's kind of be a little bit prudent here. You can see some, you got Williams-Sonoma here. There's an energy stock. Maybe we look at that. Coterra, Alibaba. We've been catching a bid on some of the China stocks. I know y'all like that one. You ask about it, so let's look at that. But I also want to look at Williams-Sonoma too, from the whole housing thing. We got a little bit overbought with the move up yesterday, backed off today, but we're also at resistance there at 100. Oh, wow, this is awfully tempting, isn't it? If we look at this, you can see that the ADX has broken above 20. It's between the two directional indicators. There's some separation there, a little tick down in the positive directional indicator, but once again, the negative directional indicator didn't tick up. So that means that really it's just kind of the buyers taking a break rather than the sellers flexing and jumping in. And we're also at the resistance area of not just 100 that served as resistance back in March and April, but that big round hole number that I talk about all the time, the whole Star Trek tractor beam type of effect here, and getting slightly overbought, hitting that resistance area. If you wanted to be conservative, you'd wait and say, okay, let's let it break above 100, then we get in. If you're aggressive, looking at the fact that the ADX is still ticking up, even with a tick down in the stock today, an aggressive move would be get in today. And if we can't break below 100, or excuse me, if we can't break above 100, then you exit. So I always try to give both scenarios because everybody's different. Everybody's risk tolerances are different. Are you more aggressive? Or are you more conservative? So the conservative move would be let's break above 100 with follow through, then you get in. An aggressive move would be, hey, I think we're gonna break above 100. The Chinese government seems to be backing off even more from their crackdown that's occurred on their top companies, which never made any sense. But it's not our concern. We'll see what happens there. So I do like that one a lot, but it would be an aggressive move. So let's see what Williams-Sonoma looks like here. Perhaps that's something that we can look at. I want to look at the energy stock. Oh, nice move to the upside there. Kind of what I thought was going on. This looks a little safer. This actually looks a lot safer. So maybe we just keep that Alibaba on the watch list and stay on the conservative side. Look at that CCI. I mean, that's awesome. And that's as good as it gets on the DMI for a continued move higher. And the reason I say this one looks better is we've already broken above resistance here at 130. So it looks like we're going to at least come test these highs just above 140. It's not a huge move, but it looks pretty darn strong on that move. No 5-wave pattern. So we're in zigzags. Let's see what the zigzag target gives us here. And there we go. So the 100% extension, oh, look at that 61% B wave correction. So, not a big move, but up to 140 or possibly testing those highs. So let's go ahead and make that one our official case study consideration for tonight. Williams-Sonoma symbol WSM. And so that's a move up to 140, just kind of same number as the MTB one. Then we'll reevaluate. Once we get there, let's see what the DMI looks like and see if it looks like we can continue higher from there. And then I would also keep Alibaba on the watch list. So I'm just going to make a note of that as well. Watch list and conservative above 100. Aggressive would be to go in now and see if we can break above 100, and if we don't, then you get out. So there you go. A little bit for everyone. Slightly more conservative here on Williams-Sonoma, a little bit more aggressive on Alibaba, and I like both of those. And gosh, we're going to have a quick show, I think, next week. Other than perhaps Chairman Powell will give us a lot to talk about, and maybe the market will give us a lot to talk about, but we don't have a whole lot of case study considerations to review anymore. We've closed them all out and done extremely well. So with that, Zach, we're a couple minutes early here for the Q&A, but even as long-winded as I normally am, I don't really have much else to say. So let's take some questions.
Let's do it. Yeah, I was going to say I don't think anyone's ever going to be upset with extra Q&A time. So let's hop right into it. We'll start out with a couple symbols from the Catalina. First one is SMCI.
SMCI. Oh, wow. So getting into kind of the tech area, and you look at this, really impressive ADX. This one is one that would have teased the heck out of you. Look, it's coming back down. We're going to break through 40. Nope. And it curls right back up. So that was kind of a psych as we come up here and turn and go back to the upside. We just missed the exit signal. It never gave one. It continued higher. And even though at this point, this is really kind of pretty impressive, really. That move was very strong. This move is almost as strong because the ADX has turned and gone back to the upside. The problem here is that we're at that target that the algorithm gave us. So can we go higher from here? We can. I think there's only a 50% wave 5 extension here, but it only had that 23.6% wave 4 correction. For those of you that are newer with us, I've looked at not just the rules of Elliott Wave, but actually the writings of Ralph Nelson Elliott himself. He acknowledged the 23.6% level as a correction level because it's a fib level, but in his mind, he preferred a 38.2% fib retracement as an actual corrective level. So I think if Mr. Elliott was still here, he would be saying, I would kind of look at this as one big impulse move with a little pullback here, not so much a correction. And, then you have to determine, when does that first impulse move in? That's the hardest part. So when you're trading zigzags, knowing where the A wave is going to end is difficult. A lot of people talk about in the 5-wave patterns that knowing where the 3-wave ends is difficult. I don't agree. I think if you can find a wave 3 with a zigzag in it, which is how I like to trade wave 3s, then you have a good idea of where the wave 3 is going to end. It's likely going to end with that correction from the zigzag completion. But when you don't have, it looks like a zigzag, Elliott wouldn't really consider it one. So I think, if you're long this, I see no reason to get out, especially with as strong as the ADX is. But I would be very cautious here, and I would have tight stops, ride a continued move to the upside, but not with a whole lot of give back here. So, I see no reason to get out right now, but I would be really cautious on this one moving forward. So what was the next symbol, Zach?
This one's going to be Adobe.
Adobe. Oh, there we go. Good old Adobe. Benefited a little bit from the whole AI craze and consolidated pretty impressively and then moved higher. Now we're consolidating again. So we've got this is slightly different, and this one's a little concerning here because we do have a slight tick up. There are some sellers that have kind of said, hey, we're taking some gains here. It's not strong enough. We're still maintaining good separation between the two directional indicators. But if we get that ADX to break back below 40, then I think you have to get out of Adobe and say, hey, that was good. Right now, it's just consolidating this gain and how it handles this level here at 520 will determine whether we can continue up towards that 600 level. We're getting, it's where you start thinking about, but we're not quite close enough for the whole tractor beam effect to take hold yet of it's going to draw it to 600. But we have to watch this ADX. And if it does break below 40, you got to get out of this one. I would say that with Adobe right now, and I know we've looked at it several times here over the last few weeks, that you stay long, enjoy that move, but you consider 500 as your stop. If it breaks back down below 500, there is a lot of support there, so it may not go too significantly below that. But if the market does weaken, we have a gap here that's not been filled well below that. I just don't think you want to give up that 500 level. So if you're currently long Adobe, I would stay long, and even a test of 500 wouldn't concern me. A break below 500 would, or a break below 40 on the ADX, and then I think you need to look to get out. But so far, so good for now.
All righty. And as we are approaching into the fall weather, which we certainly are not feeling here in Florida.
Not at all. With heat indexes over 120.
Yeah, and that's honestly majority of the states too, at least in
yeah, I know that a lot of people are dealing with the heat wave, but holy cow. August in Florida tends to be rough as it is, and we're about to head into a really tough one. It seems like with these heat indexes that we've been dealing with.
Yeah,
anyway, sorry.
A day of cold weather here in Florida with the rate we're going at, but the segue into that was for UNG and USO.
Okay, I was wondering where you were going with that, but yeah, UNG certainly not doing it any favors with this weather, but perhaps we're starting to look towards fall already. We do have a bounce to the upside. We have a long-winded alert for our alert subscribers at EWO Trader on UNG. I just feel like it got a bit overdone here down in this 6 area. And we had an extended wave 5 all the way to 125%, which means we are not looking for this big old huge move all the way back up to that wave 4. That's not going to happen, at least not in any time soon. But if we could somehow break above 7.5, then we have a nice trade here, and we're right there. We're right on it. So if we can break above 7.5, I think we're pretty clear up to 8.5, which would be a really nice gain. So let's see if we can break it. We are above the 10-day moving average. And, the market always looks ahead, and people are like, oh man, you're in sweltering heat. Why would natural gas be moving to the upside? Well, it's not moving up based on what's going on now. It's looking towards, if we've had an unusually hot winter, or excuse me, summer, are we going to have an unusually cold winter? So maybe that's what's looking ahead. But for now, we are long this, and gosh, if we could break above 7.5, then I think we could be off to the races. The DMI is not confirming that yet. If we had the ADX above 20 with the separation that's starting to occur here, then I would say, hey, we've got the go sign that we're going to break above it. We don't have that yet. It may break above 7.5 before the ADX breaks above 20. But regardless, if it does do that, and gives us the support from the DMI, maybe we could take a run at breaking above 8.5, but at least continue that run higher up to 8.5. But yeah, for the first time in a while, natural gas is looking pretty interesting. Yeah. Oh, you said USO, right? So oil, and yeah, if you've been to the gas pump, you know what's going on here. That's not what you want if you're going to fill up your muscle car like I have. This is not what you want with a big, massive V8 in the under the hood, but hey, that's the price you pay. And then the negative that we see here on USO is we are at resistance, and you could hope for a pullback, but that DMI is not giving you much comfort there. It looks really strong. It looks like we are going to break above resistance here, and that oil is going to go up and test these highs all the way back up here near 80 on USO. Now we are slightly overbought, so let's let this what would be ideal if you want to be long USO is to let this consolidate just a little bit, let that 10-day moving average catch up, and then break above that level there at 72. And then again, we're probably heading up towards 80, and the DMI would be suggestive that we're going to continue to do that. That's not going to help you when you go to fill up. For those of you that still have gas-powered cars, electric cars, it's meaningless. But if you're like me, then yeah, this hasn't felt too good with the last few fill-ups. But let's see if it can break above 72. And if it does with that DMI, which looks like it likely will, then I don't think we're done with high prices at the gas pump. Seems like, I've talked about this and referred to this a lot. There was that consumer confidence survey where a lot of people said they weren't going to travel this summer. They were going to stay at home, the staycation thing, which either they interviewed a group of people that don't have the traveling bone, or people just lied, because people have been traveling. The roads are full. The airplanes are packed. So people did travel this summer. And that's being reflected in the price of oil.
Yeah, they're having to bring in the 767s and even 777s just for domestic flights because of how many people were traveling and the lack of equipment and staffing and whatnot along those lines.
Yeah, there's a little bit of that. There's a little bit of lack of staffing playing into that too. But yeah, when they start having to bring the bigger planes in, like for the Orlando to Atlanta route, which runs every single hour, and they're still having to bring big planes in, there's a lot of people moving.
All righty. So I think, well, I know for a fact that you pride yourself in your integrity and honesty and your analysis throughout these charts. And I think everyone else out there has a deep respect for you for that. So this next one, I'm expecting you to be just as honest about. It's a question here from Lisa on how was your golf over the weekend?
Oh, well, that could have been better, Lisa. That could have been better. As I'm getting older, I had a 6-month break where I had the broken ribs and broken ankle, and I'm finding a more difficult time getting back into the swing of things, if you will, with my golf swing. Some good shots, some not so good shots. Certainly a little disappointing from the standards that I have for my golf game. So yeah, thanks for reminding me of that. I wish it could have been better. Always fun to be on the golf course though, so no complaints. Just I appreciate you asking. Perhaps you were hoping for a more positive answer, but if I am being honest, yeah, not as good as I had hoped. But hey, try again in a couple of weeks. Got another tournament. We'll see how that goes.
Oh yeah, absolutely. And just real quickly, I don't want to take any more time from Q&A, but there's been some guesses about what your muscle car is, and there's been a few that are, I believe, spot on. Lisa's guess here is a 69 Plymouth GTX, which that was a good guess. I do have some insider info, so I'll let you reveal.
I'll show you next week. Remind me next week, I'll actually show you my car and some pretty cool burnout pictures. The GTX that you're mentioning is like a dream car. I did have a 69 Dodge Charger that was in the Dukes of Hazzard show. There was 72 of them in the Dukes of Hazzard because they wrecked so many of them. It was one of those. It was labeled, I think it was number 71. But the GTX, they're hard to find, but that is one nice looking. That's on my bucket list. That's actually one that I'd like to have. So I've been actually doing some looking around for them. There's one I've got my eye on. I think it's slightly overpriced, but we'll see how that plays out. But I'll show you a picture of my car next week. By the time I bring it over and stuff, it'll waste the Q&A time, but I'll show you next week.
No worries. We'll look forward to that next week. Let's go over to 3M.
3M. Oh, old school. I like it. I like this question with the fact that the Dow's been moving. This is where money is rotating, and you can say, it's because the Dow has underperformed the Super 7, Magnificent 7, whatever. Or you can say, it's more cautious, but whatever. Nice move to the upside today on 3M. About as solid a DMI as you could expect. I hate the gap. I wish it wouldn't have gapped, because if it hadn't have gapped with that strong of a DMI, I would say, yeah, we're off to the races and we're going to at least 120, which we might anyway. And if we can get above 120, we might be testing those highs at 130. It's just the fact that we gapped up today and now we're a little above that 10-day moving average, which makes me wonder, do we have a little give back over the next couple of days? Perhaps, maybe not. That's just the troubling part, is the gap up. But when you look at that, if you could handle, even if it's higher tomorrow, if you could stomach a little bit of give back, as long as it holds above 100, it's hard to say not to be long this stock. It's underperformed everything. It just looks like this is a place where money has said, hey, you know what? We can find an underperforming stock here that we can be bullish on. I like this one a lot. Good question.
Whoops, was on mute there. All righty, let's go over to T. Robert's got some context around it. I asked about T last week and was trading at 1994 lows and dropped the next day to 13.50. $13.50, that is. Now high is 14s with earnings coming in. Does this trade look better today than last week? Disclosure, I took some profits, but letting some ride.
So clearly you're trading to the downside. This got way oversold, and it bounced back, and it's trading still under the 10-day moving average. It's holding. I don't know what's going on here. And you're right, we did get this one. And I didn't go do some research on this one. I am really curious as to what in the world is going on there. They certainly aren't backing off their advertising spend. Their commercials are on all the time. But if you're short and you took some off, good on you. That was the exact thing to do. If you still have some, I don't see any reason to take it off yet, because so far all we've done is test what was support and is now resistance. Now, if we break above 15, you should get out. That should be the end of the bearish trade. But if you still have some short, I would hang on and see if we don't maybe even come down and break that wave 5 low. It doesn't matter to me that earnings are coming up. I trade patterns, and the question comes up all the time. Does the earnings affect you? And I tend to just trade the technical patterns regardless of the earnings, because in my experience, more often than not, which doesn't mean 100%, because nothing's 100%, but more often than not, if you have a quality pattern set up, the earnings tend to follow along with what the pattern said. If it's a shaky pattern, anything it can happen. So, something was negative here, and I don't know that the earnings report is going to completely reverse this, magically all of a sudden. So I stay with what I said, that if you still have some short, as long as we can stay below 15, I would hold on to the rest of it and see if we make another leg lower. If from earnings or whatever we break back above 15, that would be the exit of a short position, I think. So
thanks, Rob. I
want to find out what's going on there, because that's kind of crazy.
Yeah, absolutely. It is crazy, and be interested to follow up on that one.
Don't understand that one at all. So I do want to, I'm going to make a note of it. So I remember having those thoughts last week, and I didn't go check it out, but I will now.
Absolutely.
All right, let's do one more.
I was going to say I took up a bit of Q&A with my back and forth there. So you got time for two symbols?
All right, we'll do two. All
right, let's go over to coin.
I was waiting on that. I almost showed it before, and I would have been surprised if nobody asked about it. And here we go. We've been talking about this. I didn't like this vertical move. I think if you go back and look at my commentary, it would have been pretty solid on that. I didn't like. It was impressive, but I don't like it when things go vertically. Now we're consolidating around the 100 level, which is a big round number. The problem is, the stock is so volatile with where that wave 4 is and where support is. You could come down to 80 and it still wouldn't concern me. 80 was resistance for a while. We had a quasi test there, but it wasn't a great one. So if you've got a longer term look at coin, which I think you should have, and I think if you look longer term, this is a really good place to be from a bullish standpoint. Just know that you might have to endure a little pain. If we come back down a little bit more, I would keep some powder dry. And if we did hit 80, I would add to it. I do think that a test of 80 would hold. It's just a shame that it was such a vertical move here, but getting rid of the regulatory issues, etc. I think long term, we're usually talking about trades here, but long term, I think coin is a great place to be. Maybe we hold here around 100. I wouldn't be surprised if that. I wouldn't be surprised if we even tested 80. But if we tested 80, I would add to a long position there. So yeah,
Right.
pretty interesting. What we got?
Oh wow, I thought you'd know from that. NVIDIA.
Oh, okay. Well, it's either NVIDIA or Tesla. I knew it was going to be one of the two. So if we take a look at NVIDIA, it's recaught a bid with the interest rates getting back below the 10 TNX getting back below 40. That gave it another run. That's exactly what coincided there. As soon as the TNX went below 40, boom, back to the upside here. We're above the 10-day moving average. NVIDIA is just, it's going to be there for the long term. And, you're going to have to endure some volatility with this stock. That's just the way it is. At some point in time, we're going to have a wave 4. We are breaking, looks like we're trying to break below 40. So maybe we're going to pause here for a little bit longer, but this is another one that if you've got a long-term horizon, then I think you could just park this one and look at it a year from now and be happy. If you're looking at it more from a trade, you want it to hold this 440 level. If it breaks below 440 and it's more of a trading thing, then get out, wait, look for another entry. So it depends on what your horizon here is on NVIDIA, I think, but they've positioned themselves for the future, and it's just going to be a juggernaut moving forward. I think, even if there's a bit of a correction in the meantime, I feel like down the road, you're going to be good there. So for a trade, as long as it stays above 440, stay long. If it breaks above or below 440, get out, look for a better entry. If you're long term, don't worry about it. Treat it like a dollar cost averaging retirement plan, and on corrections, add to it. Thanks everybody, as always, for your attention and your time. We're completely sincere when we talk about how much we appreciate it. Time's the most valuable asset we all have, and we very much appreciate when you devote some of yours to us. Hope you found tonight interesting and informative. That's what we try to do. Make you feel like it was a worthwhile use of your time. Thanks as always. Let's see what Chairman Powell says tomorrow. We may have a lot to talk about next week. Take care, everybody.